Hi everyone, and thank you for tuning in. In today's video, I'm going to answer the question if Upstart stock is a buy. I'm going to be using my 6-step framework for analysis, so let's get right into it. The first step in my framework looks at the customer value, and Upstart offers convenient lending with higher approval rates, lower annual percentage rates, and faster processing. Of course, this is favorable to customers. They like this process, this improvement from traditional lending standards, and they've accumulated 2.4 million total borrowers as of its most recent update. That's more than double the 1.1 million it had at this same time last year. So customers are seeing great value in what Upstart has to offer them. The next step in my framework considers unit economics, and for Upstart, the benefit from the difference in how they operate the business compared to traditional lenders is that 73% of their loans were instantaneously approved on the spot. This lowers operation costs. It requires fewer staff to review documents, assess credit, approve loans, talk to customers, all the time it takes and staff requirements to conduct that kind of review. That reduces those costs, so it increases the potential profitability. Further, as Upstart's system gathers more data, its loan performance will improve. It will instantly approve more percentage of its loans because it'll have more data and it'll remember these types of borrowers and their default rates, and so it will know how many more it can improve on the spot. And in turn, that will increase overall profitability over time. The next step in my framework considers its total addressable market, and according to Upstart management, it has a $6 trillion market opportunity ahead. Massive opportunity. This includes the $4 trillion mortgage market, the nearly $800 billion auto market, and the over $600 billion small business lending. So the opportunity is there. There's 6 trillion in lending that happens in our economy, and if Upstart can make inroads into that market, it could grow with a very, very high ceiling. The next step in my framework looks at competition, and Upstart is not the only online lender that offers these types of services. There are others in the industry, including SoFi, so it's not alone. And the good news is that the competition in this industry is not so much based on price, right? Customers, they're not, key. How do I word this? They're not so enthusiastically looking to find the lowest price possible, the lowest fees possible. This is a complex industry, finding the right loan for your needs. It's a complex process. And so customers might not be looking at price as the number one determinant of their decision making process. They may be looking at convenience. They may be looking at term rates and whether or not they can even get approved, right? Maybe Upstart will approve them, but SoFi or a competitor may not approve them. So that's another consideration. So there's things that are more important to customers other than price, and that's good news for investors. The other competitor to Upstart are traditional lending institutions, traditional banks. They still capture the lion's share of the loan market, and there's a hesitancy to move away from those traditional lending standards and move away from historical credit scoring methods. That's been implanted in the lending industry for so long, for such a long time, that there's going to be friction to cause customers and banks and lending to move away from that and come to this new algorithm, artificially intelligence-based lending methods. All right, the next step in my framework looks at valuation, and Upstart is not consistently profitable or generating consistent free cash flows. And so I chose to use the price to sales ratio to value Upstart, and according to this, they're selling for 1.799 or 1.8, and this is the lowest they have sold for in their brief history as a public company. This only goes back all the way to January of 2021, although it is way down from its peak of over 45, a price to sales of over 45. Now it's down to 1.8. But remember, when it was selling at over 45, this was a different business with different prospects. I say different business in terms of different business prospects. The company was expanding, growing much more quickly than it is now. The profitability was in better condition than it is now. Cash flows were better. And so the substantial decrease in price could arguably be justified because of the changing business prospects. And the final step in my framework looks at risks. And for Upstart, it's a lending institution, so recessionary forces are bringing down loan demand, both from customers to originate loans and also from the institutional buyers for the loans that it originates. Remember that when Upstart makes a loan, it tries to sell that loan to an institutional buyer so that it removes the risk off its balance sheet. It's not always able to do that, but that's the ideal scenario, is that it originates the loan and then sells it to an institutional buyer, and Upstart makes a fee from originating and maybe a margin from selling. That's its goal, but it's not always able to do that. Sometimes it has to keep the loans that it creates on its balance sheet. I mentioned that demand is falling. The quarter over quarter, so the second quarter from the first quarter, there was a 20% decrease in the number of loans originated. So that's a big slowdown from a company that's a fast growing company to experience a quarter over quarter decrease of 20%. The second risk I note here is the business model risk. These artificially intelligence infused lending practices have not been proven. They don't have a long history being in the market, how they perform in different types of economic cycles. And so investors don't have all the data they would like to observe how these loans perform. And so that's a risk in the business model. And so we're not going to know this until maybe a few economic cycles to observe how these loans that Upstart originated, how they perform compared to the loans that traditional banks originate, right? You want to compare and see which loans perform better. And without long enough time, you can't really compare that, right? You can't say that, oh, it's been better in these last 2 years. That's too short of a time frame. You need to see how it performs over different types of economic cycles, during a recession, during an expansion, during a certain kind of expansion, a certain kind of recession. And so you need more data to be confident in your assessment that these artificially intelligence infused loans will perform better. Okay, now that I looked at each step in my framework, let me give a grade for each step in my framework for Upstart. Customer value, I gave them an A plus, right? It's so much better than the going to a bank trying to get a mortgage or trying to get a car loan from a bank, right? If you could do it online instantaneously, so much more convenient for customers. So A plus in that regard. Unit economics, I gave them a B because they have the potential to offer great profitability. However, that hasn't been realized yet. They're still not profitable on the bottom line. They're still generating large losses. And so they have the potential, but they just haven't proven it yet. Total addressable market, I gave them an A plus, right? We saw that over $6 trillion market opportunity. That's incredible. That's massive. A plus there. Competition, I gave them a C plus here because they're not the only lending institution that is offering these services. And then they're also competing with traditional banks and the traditional lending methods that have been in place for decades. And it's going to be difficult to separate customers from those old habits and to bring them on board in these new processes. So C plus in that regard. And then risks, I gave them a C In my opinion, risks are high with Upstart, both because we're approaching an economic recession and loan demand growth is falling, as well as the risks that I noted, the secondary risks I noted. Let's go back and see that from the business model not being proven just yet. The fact that there hasn't been enough history in these artificially intelligence infused lending. And so for that reason, I gave them a C on risks. Moving on to valuation, I gave them a B minus. Even though they're selling at the lowest price to sales ratio in its history, that history is short. And the fact that they don't have consistent earnings and free cash flow to value them on a price to free cash flow gets them a B minus here. So now it's time to move on to my recommendation, whether I recommend Upstart stock as a buy, hold, sell, or not a buy. But before I do that, I like to remind folks here in this moment to subscribe, because my recommendation is not static, right? It doesn't stay the same. It could change from now to 2 weeks from now if there's a major update from the company, or the next quarter when the company releases its earnings updates and all of these things, factors change. So it would be beneficial to you to subscribe, because I do make update videos when companies make earnings and major announcements, and so that might change the recommendation. So even though I might recommend something right now, that could change a few months from now. So you're going to want to subscribe to get those updates, okay? So now it's time to answer the question, is Upstart stock a buy? Is not a buy. The losses on the bottom line, combined with slowing loan demand growth and the risky business model, sways me to tell investors to wait before buying this stock. I would like to at least observe how it performs over the next 2 to 4 quarters. In the event of an economic recession, I want to see how loan demand evolves, how the business evolves, and then we can make another assessment at that point in time to determine if maybe it's the right time to buy the stock. All right, that's all I've got for Upstart. Thank you for watching, and I will see you next time. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for all investors of all skill sets and risk levels. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 3 times. Go to fool.com/Parkev to get your 10 stock picks now.